You think she looks like a queen on the outside? Well, I can assure you that on the inside, she's the whole fucking kingdom.
Today we have Bitcoin Queen with us, and she's going to go over price action utilizing the 20-day moving average.
Hi, everyone. I wanted to come to you and share a little strategy that I utilize when I am trading and I'm deciding what my entry and exit will be. And also when I'm using the 20-day moving average, I will utilize that as part of my strategy for determining entry and exit. What is the 20-day moving average and how does it work? The moving average indicator calculates the average price over a given period. So for a 20-day moving average, it calculates the average price over the last 20 candles. And this is a layout of a chart. And it's pointing to your 20-day moving average, which is the red line that is running along your bars as your price action is taking place through the course of the day as your asset is running. This particular asset is Tesla. And to give you an example of what happens with the 20-day moving average so that you'll know how it's calculated, an example would be, say, if your an asset is Disney and it has closing prices for each of the last 20 days was $1 through $20. So what you would do is you take that average price over the last 20 days by adding each one, 1 plus 2 plus 3 plus 4 and so on, and adding those all the way through. And then you would divide those by 20, coming up with an average, which would be 10.5. So that means that the 20-day moving average is $10.50 for that particular span of time. Now, what I want to do is actually go and show you the chart for SPY, which actually we processed today, or this is actually a chart for SPY, and I traded SPY today. One of the things that I wanted to show is I use the concept of near and far when I do my entry into a trade. And I typically will watch my 15-minute time frame as I'm looking at the particular asset as it's moving, and I'm trying to make a determination if I'm going to trade that asset either as a put or a call. And so in order to be able to determine what my entry will be using the 20 moving average, I'm going to go to the 2-minute time frame because that's going to be my entry. I'm out to a larger time frame just so that I can see a greater span as to what the bias is for the particular asset. But I'm looking to get into it because I've determined that the bias is that I will be getting in as a call. And so I actually go to a 2-minute time frame. You can go to a 1-minute or 3-minute, but I typically use a 2-minute time frame. And then I look to see where my candles are located. So in this particular instance, I always want to enter into a trade using the 20-day moving average with the candles being as close as possible to the 20-day moving average. It's going to correlate also along with the fact that there will be activity going on with your TTM squeeze if you're using that as part of one of the indicators. And that's being utilized here. If you can take a look at the indicator that's here. And then I've also have the RSI cloud that helps me to understand the aspect of the overbought and oversold for that particular asset as well. So when I'm using the near and far, the far would be my exit, then in this particular instance, when I see my candle coming above the 20-day moving average, which would be a great time to want to enter, it's going to be close to the 20-day, but I'm looking for it to break above, because I'm going into a call, to break above the 20-day moving average. I'm also looking at the status of my TTM. And then because it's close to that 20-day moving average, then if you can see here, the price action is really nice and strong. I have a really dark green candle. This is called the volume colored bars. That's a particular indicator as well. But that dark green candle lets me know that there's a large amount of volume, very heavy volume within the trade. So to get in at the 20 moving average and then to follow that price action up, I actually have 1, 2, 3, 4, 5, 6, 7, 8 green candles in that price action before I actually see a bearish candle produce. And then if you can read your candles, you can understand that, of course, anytime you have some price action, there will be a little bit of breathing or that retest, okay? Because you can see with your volume bar here that you have a few sellers coming in. You had buyers for a good period of time. If you take a look at your volume bars, that you were able to ride up, and then you had a little break with your bears coming in to do a little bit of selling, and then you get a hammer candle here actually. And if you can read your candles going forward, you understand what's happening in that price action. And then also with your TTM squeeze, you still have consistency in terms of your bars and the firing of that action. And I'll tell you one of the more positive aspects about this move as well. You are getting in so early within the trade, and most people would be getting in this particular area here. So that by the time you ride this price action up through your bear candles, a little bit of consolidation, and then continuing forward within your bullish movement, you know that the further away your candles, that's your indication as to when to get out. So I always say the closer your bar is, if it's bearish, then it would be below. And if it's bullish, then it would be above the 20 moving average. And then you would ride that volume forward and up. And then the further away that it is where your exit will be. And you can see that the bars tell you exactly when to move out. And then you're using your other indicators. You can see the next candle there shows quite a few candles coming in. You have 1, 2, 3, 4, 5 candles, and you actually come below the 20-day moving average, but you would have closed out your contract and taken some great profits on your trade at the top of the break here. And that's almost going to be, if I use the trend line, that's where you're going to have a level of support. There, your green candle and your red candle, and that breaks down there. So most people would lose a lot of the momentum there and not be able to pull in the additional dollars that you were able to actually grasp by being close to the 20-day moving average, moving up, and then exiting as you got far away from the 20-day. I'm going to bring in, in fact, if we follow that candle down, it's actually a great opportunity to do scalping here as well, if you wanted to do that. But we moved actually from a price action of 445.99, just well say 446, all the way up to 446, rounded up all the way up to 446.88. So not quite $1 in movement, but close to $1. And you would have been able to get really nice price action in there. Where if most individuals had gotten in at this area and then had consolidation, then they're looking at maybe not even 30 cents action there. So that's a great way to be able to get a great amount of movement there. And if you continue to move up and you see your candles come down and move forward, I wouldn't necessarily play this particular one. I'd wait for price action to continue, There is another scalp, but it's close to the 20 moving average. The further it gets away and you see the beginning of that red candle form, you're out of your trade. You continue to follow that all the way through and look for another opportunity to enter. And another one to enter would be here, which would be this very dark green candle, would give you some momentum as well. So I call those little areas where you may be able to scalp. But if you stayed into the trade, because if you do your trend line, you can see that the trend actually overall was momentum going all the way up. So if you can read your candles, which we may go over a video that actually demonstrates that and talks about the individual candles, you had a tremendous amount of upward mobility there. But you can get in, you could have gotten in and gotten out there, but let it play out and continue to ride, because you can see based on the 20-day moving average that the bias on this trade all the way up to the top there is actually bullish. So you could have rode that trade all the way up, and that would have been a fantastic trade, because we're looking at, like I said, from $446 up to $448, almost $449. So it's almost a $3 gain on that one. I'll bring in one more example for us, which would be Disney. I'll bring that one up, and I'll step through that one a little bit and demonstrate it. There's another way to take a look at that 20-day moving average. And still, again, we're looking at a really nice trend line on Disney there. Really great bullish bias to ride that. And I would have actually gotten in at the area where it was far or close to the 20-day moving average. And with the movement of the candles, really, I would have rode it probably to there. I would have, just knowing the fact that I was already in profits at this particular stage, and I do typically have a stop loss on my trades. Even if it's just a mental stop loss, I still have a stop loss. So I have an idea of what my percentage would be with that small amount of movement down, but it did not break the 20 moving average. I would have continued to ride it. Still in profits even more. Continue to ride it. It still has not broke that 20-day moving average. That 20-day moving average is a really great indicator to use for strategy. And then you come back above the 20-day moving average, little bit of consolidation down, and then back up again. But I mean, even though it breaks it, it doesn't break it tremendously. In fact, I would run a trend line, and I put an alert on my trend line to get an indicator whether or not that trend line is broke, and then I make close out of the trade there. But we still have tremendous bullish momentum going in that trade. So if there's ever any doubt as to when you would want to exit a trade, one indicator would be when your price action is far away from the 20-day moving average. And as you can see, it hugged it all day long throughout that trade. And Disney has earnings that's coming up on Wednesday after the close of day. So I think if there's anyone in this trade, they'll be in pretty great, good earnings. So that's just an ideal of using the 20-day moving average as a strategy for entry when your candle is close to the 20-day moving average. And as your candles move along the 20-day moving average and get far away, whether they break the 20-day moving average into a bearish movement, or if they get far away in a bullish movement and you start to see that you're going into bearish momentum, that's when you would exit your trade. All right, I appreciate it. Thank you.
So Bitcoin Queen basically broke down perfect entries and exit points for your 20 EMA. I mean, I don't really have much to say on it. So I would say great job for breaking it down. I hope that everyone understands it. But it's fairly simple. You know, the way she said to trade it is more or less waiting for the break, ride in that line, and if it breaks through, it's time to get out. And if it stays above it, it's time to stay in. So that's it for this segment. We will be coming back to do, you know, another one possibly Thursday or maybe next week. Okay.